Good morning, everyone. We'll just give our investors and shareholders 20 seconds or so to jump online and set in for the session. I can see lots of people piling in already. So just the time we'll kick it off shortly. Okay, let's start. Good morning, everyone. Welcome to Close the Loop's FY24 results presentation. We are joined here, of course, with Joe Foster and Mark Lichtenstein, the CEO and the CFO, respectively. The deck has been released with the financial accounts on the ASX this morning, so go and have a look at those when we're off the call. The recording, this presentation will be recorded, and the recording will be sent around shortly afterwards. There is also a Q&A button at the bottom of the screen, so hit that and type questions if you have any questions as we're going through, or just raise your hand and we can unmute you and I'll allow you to pose questions directly to Joe and Mark. So with that, over to Joe Foster.
Thank you so much, Warwick, and a very good morning to you all, and thank you for joining us for our results briefing today. Before we go into the financials, I'd like to talk briefly about our strategy and vision for our business. Since the listing over 2.5 years ago, our strategy has always been to build and bolt on services with solutions for the circular economy. You may have seen an article in the Australian Financial Review on Friday speaking about Australia's Productivity Commission and how the government will support circular economy initiatives that push consumers towards better quality and long-lasting products. The idea is really to create a more efficient use of raw material and reduce landfill where possible. Every major economy and every large global company are already pushing for the same. That is a more circular outcome, and they are quite desperate for the solutions. And I do believe this is where Close the Loop can provide this solution. The circular economy is a fast-growing global mega trend, and we see Close the Loop right at the forefront, providing our very large global partners and clients with circular services and solutions. The opportunity in the next 3 to 5 years is to build a business several times our current revenue and earnings. Our acquisition of ISP Tech Services over 16 months ago was a real game changer and a big investment and commitment to this strategy. And we're very happy, of course, to report that we delivered on exactly what we said we would achieve. We are now in a position where we're producing strong free cash flow. We have 41 million cash in the bank, and with these results, we can restructure our debt with a significant interest rate saving. This really means we have the means to optionality to act on these circular economy opportunities. I think we're in a tremendous position to capture the opportunity in terms of revenue and earning growth. And I'd like to thank you again for being on the journey with us. Further to this, and some of you have already may have seen, we've been through a rebranding exercise where we brought all of the global business units together under one name and one message. Our business can be really summarized as collecting today and creating tomorrow. This message speaks through the historical DNA of the business, which is very much aligned with the future strategy around global circular economy. So today, during our briefing, we'd like to obviously go through the highlights, the financial summary and financial statement, which will be covered by Mark Lichtenstein. We'll talk about Close the Loop and then finish off with Outlook. And as Warwick has already explained, we would encourage questions and answers at the end of the presentation itself. So no doubt our figures are quite impressive, and we're quite excited, to say the least, that we've delivered on our revenue and EBITDA guidance as what we put out back in March 2023 in terms of our revenue. Total revenue is $219 million, which is 59% up on the previous corresponding period, which is achieving guidance of over $200 million. NPATA, 26 million, which is up 87% on the previous corresponding period. Amortization of 14.7 million and EPSA of 4.9 cents. And of course, the cash in hand is at 41 million after one-off earnout payment and investment in the working capital we need for our business. EBITDA, 45 million, which is up 85% on the previous corresponding period, achieving guidance of between 44 to 46 million. As you may recall, initially when we put guidance out back in March at 2023 and reaffirmed at the start of FY24. We initially put guidance at 43 million, which we updated back in the beginning of this year. Our cash conversion is 71%, so we've got strong cash flow, which allows us for reinvestment in capital management and optionality. And of course, this is very much in line with our target of around 75% in terms of our cash conversion. And of course, net debt down to 42 million, which is a 4 million reduction in borrowings in the FY24. I think this is actually quite a successful slide to talk about, because really what we believe we've delivered on the successful records and the results. Since the listing, of course, management has been consistently demonstrating the ability to grow the revenue through the organic and inorganic deployment of capital. The FY24 guidance provided up to the market with the FY23 results and upgraded with the first half of FY24. Both the 200 million and EBITDA of between 44 and 46 million has been achieved. The total revenue is 59%, with the acquisition of ISP Tech Services, which we concluded in late April 2023, is really delivering revenue ahead of the due diligence and, of course, our expectations. The ISP Tech Services, now rebranded as Closed Loop Renew Solutions, has grown during the past year, which we'll talk about later on in the presentation. The Renew Solutions contribution, the EBITDA has exceeded our expectation, and the full year final earnout of 5 million has already been paid during this financial year of FY24. The EPSA growth of 36% in FY24 is up from 24% EPSA growth in FY23. I think it's quite pleasing to see the consistent growth that we've achieved from the time we went to listing back in December 21 to date, starting off at a revenue of 71 million, where we're now very proud to announce a revenue of 219 million, and again with EBITDA strong growth sitting at 45 million compared to where we started back in December 21 with 10 million. I think from a geographical perspective, I think it's quite apparent that we made it quite clear back in December 21 when we went to the market that our strategy was very much aligned around circular economy and also being focused in the North American market. As you can see, when we started off initially in FY 2022, we had strong positioning in Australia at 68%, whereas at the moment we're sitting with 32% in this particular area. Certainly our focus within resource recovery, and certainly the Renew Solutions business is where we see a main focus for the future going forward. But having said that, we can see strong growth from a revenue across all sectors of our business. As can be said on our EBITDA mix, which tells an even more exciting story about our circular solutions and the profitability. The EBITDA margins has improved this year off the back of a very strong growth in North America, following really the investment in facilities and process post the ISP Tech Services, which is now what we call Renew Solutions acquisition. It's only been 16 months since we acquired this business, and we're just getting going with this growth with lots of strong projects in the actual pipeline itself. I'd now like to hand over to Mark for some more detailed commentary regarding our cash performance and position. But I'd like to stress that the board and management are diligently exploring every opportunity to extract value for our fellow shareholders. Thank you. Over to you, Mark.
Thank you, Joe. So focusing on the cash component of the business and the 71% cash conversion versus EBITDA. So how we calculate that is, that's receipts from customers, there's payments to suppliers divided by the EBITDA percentage. And we've generated 71% in that space. We always said that we had a target of 75%. We generated 76% for FY23. And the reason why we've fallen short slightly is because of the earnout payment for the ISP. That was deferred consideration, where there was an EBITDA target that was required to be achieved of US $12 million. We spoke about that in the previous earnings calls, as well as a significant investment in working capital. And you'll see the movement in working capital when we talk on the next slides about the balance sheet and how we've invested in the future of the business. This is normal in a business that's growing exponentially year on year. We've also had a reduction in borrowings. We've paid back our borrowings in line with all the requirements. And really the cash on hand, as Joe touched on, gives us the opportunity to determine what to do with cash going forward. It allows us in terms of expansion, capital management, reinvestment to the business, and even potentially acquisitions going forward. As we talk about the income statement on the next slide, sorry, the cash flow waterfall, the key point here on the cash flow waterfall, which is really the movement, the two areas I wanted to focus on is the payments for fixed assets of $10 million and the net borrowings movements, because we said in the last slide that net borrowings had moved by $4 million. This is the cash component of movement in borrowings. And for example, this is made up of not only borrowings in terms of long-term debt, but also the likes of premium funding, for example, on our insurance, on work cover, and also finance leases that we repaid during the course of the year. In terms of the premium funding, that's just an opportunity for us to defer payment of some of our expenses during the course of the period. The payment for fixed assets is also a key area to focus on, and that's made up of three key components. In Australia, there's the upgrade and the investment in the tonoplas line and our new facility in Reservoir. This is really a one-off in terms of the investment in Reservoir, albeit there will be further investment in future tonoplas lines in the future. And in the US, we had an investment in what we spoke about in the previous calls, was a plastic washing and separation line at our closed-loop ink facility in Hebron, Kentucky, and also made some investment in the expansion of the closed-loop plastic recycling business, a business that we acquired in February 2023, really expanding in terms of offering a greater service by investing in new equipment, new production lines, and supercharging that business, preparing it for growth in the future. So as we move forward to the income statement, and the key point here is that Joe touched on, we talk about NPAT-A. And what is NPAT-A? Well, NPAT-A really is the net profit after tax, and then we add back the amortization. And why do we add back the amortization? Well, the amortization is as a result of business combinations. So when we've acquired a bunch of businesses over the period of time, there's goodwill and other intangibles that get amortized. So whilst goodwill can't be amortized, the likes of customer relationships, contracts, and internally generated software gets amortized over a period of time. This is purely a book entry, and this will occur for the next 5 to 10 years, depending on the expected lifetime of those intangible assets as they get written off. So this really is simply an accounting entry and doesn't show a fair and true reflection of the overall performance of the business. Accordingly, we add back that business, the business combinations impact of amortization. In the current year, it's in excess of $14 million, $14.7 million to be precise, as opposed to $1.6 million in the previous year. So therefore, you can see the large movement in NPAT-A, and that's really the true net profit of the business in the way in which we look at it. We also are constantly measured by EBITDA, and you'll see our EBITDA has grown exponentially from 22 to 23 to 24. So we're showing good, strong growth as we go forward. Joe touched on us hitting the guidance, and that's very important as we go through. We've done and we've delivered what we said we would do. So that is a key point as we go through. Also, our revenue has grown exponentially. We talk about the difference between total revenue and other revenue, just to explain revenue from sales, but we have a couple of other things that come up as other income or other revenue, and so we combine the two to get a total revenue number, which is what you see on the earlier slides of $290 billion. And amounts that we occur in that other revenue, for example, foreign exchange gains, we incur every single year. It's the way in which we do our costing. And so we would expect other revenue numbers to be consistent year on year. As we move through to the balance sheet, the key point here I wanted to talk about was really the trade and other receivables, the inventory growth, and decrease in trade and other payables. That's really the investment that we've made in working capital. You'll see our trade and other receivables have gone up by $10 million. That doesn't mean we have an issue in terms of collecting cash. It's really about the nature of the growth in the business and the types of customers which we utilize and work with. We deal with a number of tier 1 suppliers and what we call OEMs, original equipment manufacturers, the likes of HP, Xerox, Canon, Konica Minolta. In the packaging space, it's the likes of Woolworths, Coles, Aldi. And these people, as you grow, the terms drift out. And it's nothing that Close the Loop can control. We get paid by everybody, but we're making an investment. Similarly, for example, in our ISP business, as that business has grown, we're offered terms to new suppliers, and our ISP debtors have grown by 82% year on year. That doesn't mean there's an issue, it just means it's the nature of the business and the way the business is expanding. Naturally, we've invested in inventory, that's to manage the growth of the business, and as the business grows with the likes of the payables, you see the payables coming down and you say, well, how is that possible? Well, in a number of businesses, we have to pay deposits to the factories. We have to pay deposits up front as orders are placed. We offer our customers terms, and the terms in the payables versus what we're paying factories and third parties doesn't always match up. So the payables have decreased, yet our receivables have increased. And that's just the nature of our business and the way in which it operates. We've spoken about the reduction in borrowings. The other key point I'd probably point out is that our intangibles has grown slightly during the period. This is also a result of the deferred tax liability increasing during the period. So as we've gone through and we have provisional accounting when we buy a business, it allows us 12 months to finalise the acquisition and finalise the intangibles associated with that acquisition. All of our acquisitions were finalised during the current financial period, and our tax advisors have advised us that we needed to gross up the intangibles and also take up a deferred tax liability. This will unwind over the next 5 to 10 years as the intangibles are written off, as I mentioned previously. As we get to the next slide, which is in relation to the cash flow, we've touched on the cash flows already, but the key point I wanted to touch on is debt. And here, debt seems to be an issue for some of our investors, and generally give an understanding of where we're at. You'll see that we have had a very high interest bill during the current period. However, we've paid down debt. We also had some facilities that were undrawn and unutilized. So, for example, the deferred consideration that we paid for ISP of the $5 million, we had a deferred drawdown facility. We did not use this. We were able to pay the $5 million out of our existing free cash flows. Our debt facilities have a long-term period to maturity, which expire in 2029, and there's low termination fees. So we spoke about this on previous investor calls, that if there was an opportunity for us to refinance, the termination fee in this current year would be 2%, next year would be 1%, and thereafter there's no early termination fee. But the key is that we have a very long-term facility. It was a 6.5-year facility that we took out last year as a result of the ISP acquisition. We have commenced some discussions in terms of restructuring the debt, and our interest rates will decrease in the next 45 days. There's a couple of factors. We expect the interest rate to decrease in excess of 1%. This is based on, our interest is based on a US lending rate, SOFR, which is like the Australian government rate, but it's the US rate. We expect that interest rates will be decreasing in the US quicker than they will in Australia. This will benefit us. There's expected to be a 50 basis points or 0.5% interest decrease in the US in September at their Fed's next meeting, as well as we get a 0.75% decrease in the margin that we have because we've had the facility in place for over 12 months and all our covenants have been met throughout the year. And because we're in such a strong cash position, the margin associated with the debt facility that we have will also decrease. So overall, our interest will decrease as well as we're looking to renegotiate as we go forward. Thank you. And back to you, Joe.
Mark, thank you very much. And I'm sure we'll all agree, quite impressive numbers. So thanks very much for delivering those. So the way we see it is that we're on a very high growth business and a high growth industry. We certainly will continue to execute on our growth plans following our years of investment in working capital, new facilities, services, and innovation. In the coming years, we would expect growth from the following areas. If we look at the growing the HP certified refurbishment solution globally, and our idea really is to try and expand our positioning, not just within the North American side, but also to do the same in Europe and across into the Middle East. We're quite active with this space and certainly helping HP for them to realise their global plan around Renew Solutions to achieve their ultimate goal of 2030, and that is to have 70% of their products refurbished between 2 and 3 times. Looking at efficiencies and scale within opening our Mexicali facility and also a Middle East facility. And then, of course, we'll obviously bring in new revenue streams and improve efficiencies from a cost reduction point of view as well. The multi-vendor take-back program in Europe is just one part of our business expansion in Europe, and of course, looking to expand into the printer refurbishment area of the business. This multi-vendor take-back program has gone from strength to strength with more OEMs coming on track and expanding throughout Europe. In September, we're actually hosting all of the OEMs at our Belgian facility to renew and finalise the next stage of this process. And of course, the additional facility of printing refurbishment at our Belgium facility will only just enhance our position within the Renew Solutions strategy, and of course, allow us to be placed to work with other OEMs within the European Union. Then we're looking at increasing enlargement within tier one packaging customers, not only in South Africa, but also across Australia. What we're finding is we're seeing quite a lot of activity, both in South Africa and Australia, with the multinational brands, with most high emphasis around sustainability and reusable packaging, very much around the targets that are in place for 2025. And of course, looking at acquisition of feedstock from other OEMs and ITAD, reducing customer concentration. One of our big drives was to look at other ways of bringing revenue streams into our IT refurbishment space. We would expect that within a year from now, or just over a year from now, we would most likely reduce our customer concentration to about 50%. I know we're quite ambitious, but personally, that's the plan. And we believe we should be able to get there within a year or so from now. And of course, the reuse of soft plastics, which is really critical initiative for the company and the community. The soft plastics issue will still be a major project for the business, and plans are afloat to have additional Tonoplast sites across Australia with strong government support from government support to get grants to put these facilities in, not just in Melbourne, additional facilities, but looking at South Australia, Queensland, and of course New South Wales. Looking at our locations around the world, and of course, we're pretty ambitious where we want to be in the future. Currently, at the moment, we've got 4 geographical areas where we operate, mostly from North America, Europe, Australia, and South Africa. Of course, what our plan is in terms of the future locations is to be in a position where we, as mentioned earlier, we'd have a facility in the Middle East, as well as the facility in Mexicali in Mexico itself. And of course, our global customers across all our sectors are continuing to grow. What we're finding is that we're working with a lot of tier one clients across the world. A lot of these clients are international based customers where we can provide similar services, not just within North America and Europe, but of course, we're seeing the same happening in Australia. We're seeing a lot of cross opportunities between the Renew Solutions business and what we call the Circular Solutions business, which is the actual what was the print consumables, as well as take back programs for cosmetics, print cartridges, and e-waste. And we're seeing the opportunity thereof to start bringing on board not just print consumables, but certainly the actual hardware itself, printers and so forth. And of course, our customers in these areas, not just within the Renew Solutions, as well as the print consumables, the packaging client base globally is also growing, which is quite positive. What we're finding in Australia, the targets are still a long way off for the desired result, but the industry and brands are still pushing with regards to the packaging side of it. The Australian Packaging Covenant, APCO, is still targeting 100% of packaging nationwide to be reusable, recyclable, or compostable by 2025. I know it's just around the corner, but big brands are still insisting on this change, even though it's a bit of a way off. We still believe it's quite an important trend to achieve these numbers and certainly introduce packaging that's more sustainable. And of course, recycling waste reduction bill is still in place, and the bans are still there of the export of glass, plastics, tires, and paper itself. I think Europe is quite interesting, certainly with the new directive in place with the right to repair, which is about the aim to extend product life cycles by making repairs easier and more cost effective, particularly for consumer related items. In Europe itself, the targets are set by 2025 around electronic items, and it's closing in quite fast. Certainly with France's target set at 20%, and Italy's already set at 30%. We would expect to land anything between 30 to 40% as the program takes place in 2025. I do honestly believe the multi-OEM take-back program is also a great help across Europe and assisting with us to have our OEMs achieve their targets. And of course, this is very much in line with the Waste Electrical and Electronic Equipment Directive, which is the WEEE directive that's been in place in Europe for quite some time. And with HP's the sustainable impact, we've obviously been assisting HP across their Renew Solutions programs, with our business being the first global platinum partner to take part in this program. On the packaging front, we're also helping HP, and I've just recently set up a task team to assist them with their journey towards eliminating all plastics. The HP Life Extension service is about 75% of circularity of products and packaging by 2030. To recycle 1.2 million tons of hardware and supplies by 2025 from 2016, and use up to 30% post-consumer recycled content plastic across personal systems and print. I think their idea really is to try and eliminate as much plastic as they possibly can when they go forward. And then we look at the company from a snapshot perspective. We've got over 380 staff across 4 different geographical areas. Our core business and our core activity is what we say is collecting today and creating tomorrow. We collect anything from print consumables, IT products, cosmetics, batteries, soft plastics, and so forth. And what we do is we create or remanufacture or repurpose based on what we take in. Our business is very much about a reverse logistics business with over 300,000 collection sites and the ability to repurpose as much as we possibly can, with our main objective to try and avoid as much product going to landfill as possible. If we look at the shares on issue, we got 531.8 million shares on issues with a market cap of 168 million, with 41 million cash and 83 million debt at the moment. The major shareholders is still sitting at Foster Packaging, Omniverse, Wilson Asset Management, ASLDH, which is Sammy Salmon from ISP Tech Services, and of course Green Cape Capital. And just really to finish off on the 12 months relative share price performance versus the small ords index, is that we really believe the share price is not a fair representation of a performance of the company's value this year. Much of the advice that we've been provided has been to focus on what we can control, which is really executing our expansion plans, providing our customers with market-leading services and innovation, which is exactly what we have actually done. Ultimately, as our revenue and profitability grow, we believe the share price will take care of itself. I do truly believe that in FY24, the results are another clear step towards our goal. And again, I really want to thank you all for your support, and especially your patience and belief in Closed Loop. So thank you very much, everybody, for your time. We really appreciate your attendance today and look forward to your questions.
Right, let's kick off some questions. I can see Larry has raised his hand. Larry, if you want to take yourself off mute and pose your questions.
Can you hear me, guys?
Yes.
Oh, great. Okay, well done on a successful FY24 closed loop team. A few questions from me. Just looking at packaging, Joe, obviously traveling below next year. Is there anything that you can call out that should flatten the result for FY25 or perhaps restore some growth?
I think we are confident, and certainly we've got the ability to have those, let's call those small fixes, Larry, to return the business into a more stronger, profitable position. That's really our aim, to take the packaging business forward for next year. Or for FY25, that is, yeah.
Anything, what do you think was the main issue in FY24? Was it particular contracts or output pricing or exchange rates?
I think it was a combination of many things. I mean, the market itself, there was a slight slowdown in the market, although the second half for packaging was pretty strong in comparison to the first half of packaging. I mean, again, it's there's also seasonality. There was a bit of a slow off between February and March as a result of the Chinese New Year. Of course, one can say whether that was actually budgeted for or not. But as I said, Larry, we are pretty confident and bullish about our future around the packaging space, not just in the Australian market, but across into the South African market as well. In fact, the South African business performed exceptionally well, considering the circumstances that it operates in from an FX perspective as well, and also the situation that takes place in South Africa. I'm not sure whether Mark would like to comment on that further.
Yeah, I just think that.
Sorry, Mark. Just I was going to say, is it one of the particular businesses within packaging that's an issue?
I think there's maybe one or two small businesses that we're aligning, that we're fixing in that space. As I said, nothing from our point of view to worry about. I mean, Larry, if you think about it, we got a number of packaging businesses. Okay, there's
Yeah.
a degree of crossover. There's certainly a degree of commonality through our customers. And this was certainly recognised within the first half of FY24, where we needed to align our focus for the fixes, if you want to call it, really these small fixes of these businesses to put them back on track. So I am, and we are confident about what needs to be done within the packaging space. I mean, again, if you look back at our history across all our different business units, there's been sort of ups and downs across the business units over the last number of years, last 5 or 6 years, and it's something that we're certainly not concerned about, Larry.
Okay, I got that. So I think that's fair. Maybe I'll just move on to my next question. You talked to, you've identified perhaps some acquisitions in the U.S. I imagine that's in resource recovery. When you think about acquisitions there, is there opportunity to actually build on the existing ISP tech platform? In other words, very similar businesses, maybe just different customers? Or are you more likely to kind of step away from, not because there's anything, no issue, but just perhaps the acquisition might step away from exactly what you're doing now?
Mark and myself would like to answer that question. I think if I refer to slide 13, looking at the organic growth and the plans that we've got, looking at the existing business units itself, even looking at North America, there's a number of very strong projects we have in the pipeline that takes us out of the customer concentration, the heavy customer concentration that we have currently at this moment. And we will see some big changes as a result of bringing in these new programs through organic growth to allow us to expand, not just within the existing OEM, which we've obviously got quite a good relationship and there's lots of opportunities there, but outside of the existing relationship into the ITAD space, where naturally it'll bring us involved in other OEMs and other clients in that particular market. So there is a strong focus from an organic perspective in the North American market.
Okay.
Mark?
Yeah, if I just want to add to that, Larry, we've identified opportunities that are both, in line with the ISP type business, as well as potential where it might expand the service offering. But the key point here is that we're still investigating, we're still doing our due diligence, we're doing our homework. There's opportunities in both, as I say, expanding the business and, expanding the service offering like for like, giving us greater geographical spread. But it also means that, there's nothing that's imminent, and we're certainly not coming back to market imminently to raise money in any shape or form. At this juncture, we've got the 41 million that we highlighted in terms of the cash. The business produces strong free operating cash flows. And at this juncture, things that we're looking at are not on a huge scale that requires us to go back to market.
Okay, and just a couple other questions, maybe just technical here. Mark, in the FY23 presentation, net debt was 38 million. And in this report, I think you're calling out 43 million of net debt or thereabouts.
Yes.
But then there's this comment that we paid down 4 million of debt. So I'm just wondering if you can help reconcile that.
Absolutely. Because if you look at what's net debt is the total borrowings less the cash on hand.
Yeah.
Cash on hand last year was 49 million at the end of FY23. At the end of this year, it's 41 million on hand. So that's where the difference is. It's the movement in the cash balance as much as the movement in the borrowings, right? And that's where the difference is when you reconcile.
I see.
Right?
Okay, so you're saying you paid down 4 million of gross debt. Yep. Okay.
4 million of gross debt, and that's on the long-term facilities. Okay,
that's understood. And I guess on that though, when I look at the free cash flow in the business, it was actually positive. So I'm just confused as to how net debt would expand from 38 to 42 when you actually had cash from operations. Maybe we'll take that offline. And I guess let's take that one offline. I just wanted to ask about, there's about $3 million of other income.
Yeah.
Can you just tell us what that was?
Yeah, I can. The other income, it's lots of bits and pieces. There's also a legal settlement in the Belgium business that have been going for a number of years, actually dates back to 2014. And that was settled during the current financial year. That's the lion's share of the 3 million. But there were costs associated with that. So it's not just that we got I call it a free kick during the period because we incurred some legal expenses. The matter went to trial and appeal, and we incurred some costs associated with that. So that's the main, the lion's share of what that makes that up. But there are really, if you drill down, there's lots of bits and pieces across the 13 different businesses that we manage and operate.
Okay, fantastic. Thanks, guys. Well done.
Thank you very much, Larry. Mark, question for you, I think from Connor. ISP Tech Services would be a major contributor to the FY earnings. Could you provide a like-for-like for FY24 EBITDA?
Yeah, good question. Thank you, Warwick. Yeah, so what we've done is we've done the calculation based on the organic growth within the business. And we've looked at it from FY22 to 23 to 24. And we said if you go back to the earlier earnings calls, we always aim for an EBITDA margin. Historically, is around about 16%. We actually generated 16.3% EBITDA for the organic business. The organic business has showed growth. In fact, from FY22, organic EBITDA moved from 13.8 million to 15.2 million over the 2-year period. It's up on FY23. Our gross profit margin has also increased slightly from FY23. So overall, whilst the revenue is down on the organic growth, our EBITDA has increased on the back of the increased gross profit margins and EBITDA margin for the organic businesses.
Very good, thank you. And a question from Ron, just on the debt restructuring. Could you provide a view on timing and the new facility?
Yeah, and I think I indicated on the half-year call that what was required was when we went out and we took the facility, it really was a cash flow lend for what we did within Close the Loop as a result of the ISP acquisition. We now have a strong balance sheet. You've seen we've got debtors, we've got stock, we've got a traditional business, we've got a trading history as a combined group, and we've got a new set of financial statements that sets the baseline going forward. With these baseline financial statements, we're now in a position where we can go back to the market and reconsider our debt and refinancing of the debt as we move forward, and we would expect to have something completed in the coming months, certainly this side of Christmas, where we can make some further announcements to the market as and when required.
Thanks. And a question from Liam. In the result release, you note the need to invest in additional refurbishment capacity. Could you please discuss the scale and timing of potential investments, where within the RTED space it will be focused, and what options you might have in matching this investment against revenue?
Yeah, I'll take that one. This is really in relation to what we speak about the Mexicali facility. It's not capital intensive to expand the facilities. It's labor intensive, more than capital intensive, particularly with ITAD. It's about people, it's about processes. And really what that's going to do is generate future savings within our existing ISP business, as well as expand on our service offering. And that's where Joe spoke about being able to access. We've put it in our results summary in relation to getting up to 25,000 laptops in a month or in a period, refurbishing them and selling them as a certified refurbished product. So it's really about the having the capacity and the space to do that with the people that you required, rather than a capital intensive, which is what we see in the traditional Close the Loop business, which requires big pieces of equipment and big pieces of kit to expand your service offering. There's quite a distinct difference there.
Another question from Ron. Can you please expand on your comment on slide 8 that the board is exploring all options to extract shareholder value?
I'll take this one, Joe. This is really in relation to the opportunities that the board has in front of us. I spoke previously about capital management, having the extra cash, the 41 million, and a business that generates free operating cash flows. This really gives us the choice of how best to manage the business going forward in terms of what to do with the capital and the free cash that we're generating, and how best to generate greater returns for shareholders. I think you can see from our track record, we've grown the business exponentially over the 3-year period, over the short time we've been listed. And really what we're saying here is that we've got the choice to make more moves, to make more changes. We're confident the business will continue to grow. We're confident that the business will continue to grow over the coming years. We indicated that in our outlook statement. And again, you'll see that the real question here is, does it fall in FY25? And that's really just a marker in time, or is it over the next 2 to 3 years? We don't operate and think that, it's 30 June, we must finish everything. We're on a journey, and it just so happens that financial years are certain markers along the journey where we give an update of how we're progressing.
Thanks, Mark. There are a number of questions just on the interest bill payments and the debt. I think we've already addressed that and the restructuring of the debt to come hopefully in the not too distant future. Another question from Connor. What is the tax rate on the NPATA figure? Mark, I'm not sure if you've got that to hand.
I don't have it exactly to hand, other than to say the tax rate is really, it's a combination of the 21% that we pay in the USA and the tax rate of 30% in Australia. We have carry forward losses in Belgium, and then it's the South African rates. It really is a shandy. It is in the notes to the financial statements. There is a reconciliation back to the overall tax rate that you can find in the notes.
Again, relating to the debt, Mark, is there any expectations around interest rates and the savings that can be achieved?
Absolutely, I touched on this before. We would see the interest rate within the next 45 days decreasing by 1.25% with our existing lender. And then on top of that, it's obviously, as we go back to market, we can consider our options and see further decreases. But the 1.25% is real.
All right, and a question from Connor, again relating to the outlook and what CapEx can be expected in FY25, given the investments we've made this year.
Yeah, so CapEx will certainly be lower in FY25 than what we've currently experienced. We experienced up to 10 million in CapEx, and be significantly lower. But again, the business is growing, and as we expand, as we touched on, there'll be some CapEx required with the Mexicali facility. We would expect that to be, $1 to $2 million in terms of setting up that facility. And then as we expand, we touched on before the expansion of Tonoplas, and we mentioned the government grant. The government grant, for example, allows us, it was indicated in the results summary of 2.2 million. We have to match that dollar for dollar. So for every dollar the government puts in, we put in a dollar. Whether we spend all of the government grant or not, that's debatable, depending on the technology that we utilize for the second Tonoplas line. So there'll be a few million, we had indicated previously that our CapEx generally would be in line with our depreciation. Depreciation this year was $6 million. Historically, that's normally our CapEx is in line with that. So to go back and answer Connor's question, probably will be in the region of $5 to $6 million next year. We won't have these big one-off amounts that we had in this current financial period.
Couple of quick fire ones. Any earnouts payable in FY25?
No, all earnouts have been paid. The only small one is in relation to the plastics recycling, where there's a note payable, the $250,000 over a 4-year period. We paid the first of those notes this year, so a total over the next 3 years of $750,000 is the only earnouts that are existing. There's also a very small earnout in October for the pouch shop in South Africa, which is required to be paid, but that's 4 million rand plus a few other bits and pieces.
Several questions relating to gross profit margins, noting the increase year on year. Can we expect this level to be normalized over the next few years, or can we expect increased margins due to Mexicali?
I think it's fair to say normalization of our gross margins over the course of the next couple of years, for sure. While Mexicali is important and other areas for low-cost manufacturing, I think as we bring on more business, and particularly we highlighted the fact that we're bringing on more tier one customers within the packaging space, certainly from a gross margin perspective, we would, of course, look to increase our revenue, but margins would not be at the same expected level as what we're currently doing at the moment.
Geographically, Joe, where do you expect to foresee the greatest growth in the coming years? Just a note to say that they are particularly surprised to see Europe remaining at quite low levels.
But again, if you think our growth phase is North America and Europe, we would expect, and we've said this many times, we would expect the European business to be of a similar size to that of North America. While Europe's sitting at 4%, it has had growth, particularly this year when we compare it on the previous years. The fact that we're getting involved in printer refurbishment and expanding our services through print consumables, we'll see some nice significant growth across Europe.
And then maybe just a final question before we wrap up from Liam on the Tonoplas plant. So what's the update on Tonoplas?
Yes, indeed. We're actually currently running tonoplast at the moment at our plant, and as we put out the notice previously, we're in the process. We will be in the process of relocating our plant due to some challenges that we've had around EPA. When we were setting up the plant back in December 21, or sorry, I beg your pardon, back in December 2023. The ramp up went relatively well. With new technology, we didn't anticipate various changes to the process that required us to have more stricter processes around our EPA requirements. And we would expect the ramp up to take place over the course of the later part of the calendar year 24.
Right, I think we've addressed the major part. Probably in concluding, Joe, I'll just repeat this question to you, which notes that while the results are great, the share price seems to be going in the opposite direction for the last little while. If you want to maybe wrap up on that note.
Yeah, certainly. And as I indicated, I mean, I do honestly, truly believe we have a good business. We are investing in the future. Personally, I do believe the business, looking at this business a year from now or 2 years from now, there's no reason why we wouldn't double or treble the size of our business. What Mark, myself, and the team want to do is continue to deliver on our numbers, which I know we are. We're delivering on strong growth, strong earnings, and strong EBITDA. We would expect that to continue over the course of the next couple of years, when we certainly look at the number of projects that we have across all of our geographical areas. It's very sad to see that the share price hasn't been reflected in our success. And hopefully what we can do is really to be in a position to just carry on growing, do what we do well, and that's make our business a real success. Looking at what we have, as I mentioned, in the pipeline, there's no reason why our business will continue on the same lines it has been over the course of the last 2.5 years. So thank you so much for the opportunity to present here today, and we want to also thank for the support from our shareholders, current and future.
Thanks very much. All the reporting will be sent around shortly. Enjoy your day. Bye.